like the best idea in the world. And it, for the last 2 or 3 years, undeniably, it has been the best investment idea in the world. Even getting that right, when you add leverage, the risk of complete loss is still there. It was up like 1,000% in a year or 2 years or whatever it was. 20% decline, I think, like because these names are down, somewhere between like 15 and 20%, and it got totally wiped out.
Because if you're leveraged 5 to 1, the 20% loss loses you everything.
Is a zero, totally wiped out. And so we thought we should talk about it. It's a good moral lesson of investing.
This is the Ordered Life podcast.
Are we recording?
Yeah, we are now recording. Okay, so we have some topical news on the podcast, and maybe we'll release this tomorrow because we need a podcast this week. Sean, do you want to give the
so following
spiel?
the blow up of the Situational Awareness Hedge Fund, and just to recap those who are not aware, a German young man, Leopold Aschenberger, I think is his last name, started a hedge fund. I think it was either I think it was 2023. Former researcher at OpenAI, immensely successful with basically one idea, which is that AI is going to change the world, and it's for real, and it's going to be massive. And he was extremely, extremely successful with running his hedge fund, and it grew to massive proportions. I think it was up to like $45 billion or something.
From what starting point?
Oh, I don't know.
Yeah.
Like I presume his own personal funds along with
raising
close
capital.
friends?
I'm sure he was raising capital all along the way. So the only reports I've heard of just sort of where it was peaked out at in terms of assets under management, I think I heard around 45 billion. So I believe this to be true, but don't quote me. And so the way he expressed this, one idea, AI is going to change, it's going to be big, it's going to change the world, it's for real, is to buy all the companies that we're going to be benefiting, like all of the hardware names that we're feeding equipment into the build out, all the energy names that we're going to be in demand to power all the AI data centers. And he was going to short sell, which for those who don't know, shorting is when you are betting the price of a company to go down. He's going to short all of the companies that were going to be disrupted, software companies, brokerages, certain finance names. And then on top of that, he was using leverage, so investing with borrowed money. And so if you are running a hedge fund, there's two sort of paths you can take if you're doing this sort of long, short, leveraged hedge fund, is that you can have a bunch of ideas that you own that you'll benefit when they go up, and you have a bunch of ideas that you short, so you benefit when they go down, but they're not connected at all. They're totally disparate, totally diversified. There's no correlation between them. And if the market goes up, your return is just the difference between your shorts and your longs, and same thing on the other side. If the whole market falls, you're not really exposed to that risk. You're just exposed to the difference between shorts and your longs. So you're kind of insulated from these market movements. It's actually a way to have less risk. So you can apply leverage to that, and there's ways that can be done sort of responsibly and not crazy. So this guy did the opposite way. So even though they have the same inherent structure, there's a bunch of companies you own, there's a bunch of companies you are short, and you have leverage. They're all connected by the same central idea that AI is going to change the world. So as long as that idea is moving market prices, you will do unbelievably well, which he did. He was up like 1,000% in a year or 2 years or whatever it was. But that the problem is, if that idea ever turns, the companies you own go down, the companies you're short go up in price, which means it's your negative return. And then you apply leverage on top of that. So
it's magnifying on money you don't have.
Yeah, they had a 20% decline, I think, like because these names are down, somewhere between like 15 and 20%, and it got totally wiped out.
Because if you're leveraged 5 to 1, the 20% loss loses you everything.
is a zero.
Yeah.
And he's not totally wiped out because they own some private equity. And so that was not, there's no mark to market there. There was no volatility. That stuff is fine. But all of his public equities were zeroed.
Jeez.
Totally wiped out. And so we thought we should talk about it. It's a good moral lesson of investing, which is, well, what? Like the best idea in the world. And it, for the last 2 or 3 years, undeniably, it has been the best investment idea in the world. Even getting that right, when you add leverage, the risk of complete loss is still there. So it kind of comes back to humility versus pride. When it's not just all your eggs in one basket, right? Because he had a diversified portfolio of companies he owns and companies he was short. But it's the pride in this unwillingness to recognize that I could be wrong with this one idea. So I think that was a key ingredient, hubris. And then leverage. What do we think of leverage in investing, generally speaking? What do we tell people we work with? You should avoid leverage in investing because far more important than generating high returns, it's just surviving. So if you have leverage, let's say you have no leverage. The worst you can ever do is lose all your money. But if you have leverage, you can lose more than all your money.
Yes.
Yeah.
And it's much, much worse. And if you're leveraged 5-to-1 and the market goes down 20%, you have zero. So then this is I think this is greed and avarice, right? The desire to maximize returns without consideration of the risk, and the risk being total loss is much worse than just a 20% decline.
It's interesting you bring up that element of pride because that is essentially the root of it. That and greed. But I appreciate the fact that he is passionate in terms of his perhaps, and I'm presuming, I haven't had a chance to read the article, but I'm presuming he's very convicted in which, like, this is a great idea. And he wanted to put action
just
to
on
it.
that thought, like, it could seem like it was courageous, but it was excessive courage to recklessness.
Yes. There's an element of being bold, but then also the possibility of being reckless. And it sounds like in this particular case, he was.
Yeah, no, I agree with all of it. I think the really big theme that stands out there is, again, investing is a school of virtue, and you have to know thyself. You don't rise to the level of your goals, you fall to the level of your systems. And so even when we're doing our investments, we don't look at our diversification by industry. We'll have that idea in the back of our minds, but the far greater idea of diversification is our idea diversification. And we don't want to give more than a specific allocation of our portfolio to a given idea, because we know that, hey, we can have the best idea, and it can be the best idea, as this story points out, but at the same time, what does it matter? Like things can go wrong. Like timing can be not in your favor. And the other part of that,
and that's the worst. Not the worst. But kind of the worst part of it is that he's still probably going to be right.
Yeah.
But that doesn't mean the market's going to agree with you, or the market prices are not going to be volatile and maybe irrational or short-sighted, but that at least temporarily it can disagree with you.
Yeah.
So how do we deal with that? We absolutely will have high conviction ideas and are tempted to overload a portfolio with companies that are all exposed to the same theme or idea, but we have limits.
Yeah.
Because we recognize we can be wrong. The market can be crazy. Therefore, the system imposes limits upon us, and we respect those.
Yeah.
And then use of leverage. Oh, just never invest with leverage.
Yeah. And I think you make a good point of like, what's the actual purpose of this leverage? Because yeah, if you're playing around with an equation of like, how do I maximize return? Adding leverage to that equation is 100% going to let you maximize return.
It always looks better. Yeah.
Yeah. Like absolutely. And the whole idea is like, hey, if you can pick stocks that are going to go up, and then, well, if you're good at knowing what stocks can go up, you can probably know what stocks are going to go down. Now you have a market neutral long short. And then you're like, well, if I'm good at doing that, then I can just add leverage to it, and all of it goes better and better, but it compounds, right? And then that's how you get into this situation, where funds can just blow up overnight because of those decisions that are made. And so I think, at the end of the day, it's like, yes, the math equation, but at the same time, like, what are you trying to maximize for? Because if you're trying to maximize for profit, 100% going for it, use leverage. But you, as you have more risk, as you have more return, you have more risk, and then on the downside, you definitely bear that.
Mm-hmm. I'm curious what his thought process was as he's seeing this unravel of what his original intention was, that this is going to be fantastic, and slowly unravel. Like, what processes did he in place?
Well, even to make that thought process even more dynamic or just wild is that in the 3 months leading up to it, like the semiconductors had the best return they've ever had ever, and that's where he was mostly exposed to. And so the complete polar opposite, you went from having like the best quarter you could possibly ever have to being zeroed. And he's getting married this weekend, so I feel really bad for the guy.
Oh man. Hey, you know what, Kate? Good for him to get married at 24.
That's true.
Yeah. I like it.
Yeah.
Has he shared his thoughts as this is kind of occurring for him and his hedge fund?
I think so. So from what I've read is that, and this is from sources I believe to be true. I don't know that they're actually true.
Is he divulging these details?
I think he wrote a letter. He wrote a letter to his investors.
Oh, okay.
And the letter says, like even after our public portfolio got liquidated, we're still up 80% year to date.
Wow.
Which is great for anyone who was in at the beginning of the year. And it's mostly because they had stakes in private companies that don't have volatility, or they don't have measurable volatility. But for anyone who invested after the beginning of the year,
you're in head.
And it's not that they even might have a zero return. They can actually have a more than zero return, because some of these stocks were liquidated with gains, so there's tax liabilities that can be passed on. So you have a total loss and then a tax bill for some people who were like late to that.
It's like an ouchie, salt in the wound.
Yeah.
Did he give it's like, hey, I recognize this has happened. This is kind of the new path that I've carved.
Oh, and then I
double down again.
No, I think it was, we've learned our lessons.
Okay.
We will do the same strategy with no leverage.
Yeah.
Okay.
Yeah.
Is my paraphrasing my understanding of
I think it was like some parts leverage, but like much more covered. Might have been what I read.
Yeah. And then it also speaks to the greed, not of him, but of Wall Street and his investment banks, who let a 24-year-old with no investment experience go.
Oh, someone handed him the keys to it. It's not like he just decided to take this endeavor
no
on his own.
normal person can go 4 or 5x leverage. No, you have to have special accounts with major banks. Yeah.
That they saw the same thing that he saw and it's like, let's do this.
Yeah. And I don't know. I don't know if they are thinking, well, if it doesn't work out, we just sell them out and that's fine for us, which is also, I mean, that's just, if that's the line of thinking behind his bankers, then, I mean, that's just completely uncharitable and an awful way to let someone ruin themselves. But they have to know that was going to be
a possibility. I'm sure they had to do their own risk
assessment. But not just a possibility, like a likely possibility,
right.
Eventually.
Yeah.
But they also probably saw the tremendous potential rewards financially as a result of that they were willing to take on that risk.
Right, so their own greed led them to do that.
Right.
And then their own lack of, putting limits on this extremely successful fund. So I think they definitely share part of the blame of that as well. Yeah.
Yeah. No, I think, leverage is an interesting thing because it can be used for good. Like, I mean, everyone technically is like Would you consider it like leveraging your home by having a mortgage because you're borrowing to be able to buy it?
Yeah. Oh, yeah.
Yeah.
I mean, that is the trick, right?
Yeah.
You put a down payment on the house,
Which represents
20%,
a percentage,
yeah.
where it's smaller. It's
5 to 1
Yes,
leverage.
yeah.
Same thing, house investment, but it's much less volatile.
Yeah.
And there's no margin call, meaning you're never forced to sell your house.
Yeah.
So you could just sit with it.
Yeah.
So it's different. It's very different. But then the real estate investor is, they'll just wait till the house appreciates, remortgage, have enough down payment for another house, wait for that house to appreciate,
Rinse and repeat.
remortgage, do the same thing.
Yeah.
And now they're massively leveraged to one idea. And we saw in the last couple of years how that can work against you.
Yeah. Yeah.
I did have a thought in terms of those who are affected poorly by this hedge fund. Some people might say, well, oh, what does it matter? It's really, really wealthy people invested in this hedge fund. So good, like it's an element of,
You get what you deserve.
yeah. But I'm imagining some of those people took that same level of conviction, therefore greed, that they could decimate their own families too.
Yeah.
And they were like probably well-to-do, and then they just were even more convicted. Okay, let's put 100% allocation of our thing, and let's go with this thing.
Yeah. I mean, I imagine nobody did that. I imagine, I mean, it's a hedge fund with a massively leveraged bet on AI. I assume everybody who was putting money in the fund did not put 100% of their investable net worth. And also it speaks to, like, you have to be a particular type of investor to access these
It's
funds,
true.
which shows that, regulations sometimes get a bad rap, and sometimes they're totally reasonable and justified and a good thing, and helping, saving people from themselves.
Themselves, yes.
Because like if you have to be an accredited investor, you have to have a certain net worth. We assume if you get zeroed, you're going to be fine. Like those are good things. Yeah. You should keep smaller investors who are maybe going to be putting their whole
Decimated
net worth
because of that, yeah.
You can't take a loss. Yeah. You should keep gates up, keep people out.
I still think it'd be a difficult conversation within the family. Hey, hon, you know that $1.8 million we put towards this? Yeah, it's gone.
Well, for some people, yeah. But other people, like, you still have 80% in the year.
Yeah.
True.
Yeah. Well, and even it's like when Ontario Pension Plan lost their entire bet on, what was it, FT?
WeWork?
I know what the WeWork. I was thinking Bankman Fried.
Oh, yeah.
Yeah.
FTX.
Yeah, FTX.
That is
Yeah.
it. Yeah.
The $93 million position.
Yeah.
Like just wiped out overnight.
Yeah.
But I mean,
Well, the response to that, I don't know if it was them or a different one, because a lot of people did that.
Yeah.
Look, we're in the business of taking risk.
yeah. And like
it's true.
when you looked at it, it's like it was like 0.00 whatever of the portfolio.
Yeah.
Like it didn't. Yeah.
Yeah. It speaks to another principle, is it's not really what you buy, it's how much of it that you buy.
Yeah.
That's
The poison
problem.
is in the dose. Yeah.
Yeah. There are there's some room in almost any portfolio for higher risk and speculative stuff, as long as it's appropriately and proportionally sized relative to the rest of the portfolio, so that if you do take a total loss, it's not painful.
Yeah.
So yeah, you can lose 0.1% or 1%. Like the market moves more than 1% in a day. If you take a total loss in a 1% position, that's not that big a deal. So yeah, unless all your 1% positions are correlated with all your negative 1% positions, and then you get zeroed.
Yeah.
In this case, and so it speaks to another point too. So, in the investment world, the strategy that will go up 1,000% in a few years, or that will be up 500% year to date, is also the same strategy that will be down 100%
Yeah.
in a similar time frame. Like, they're perfect mirror images of each other, right? There's no free lunch. You can't have the opportunity for unbelievable returns without the risk of complete and total loss. So it's a red flag for anyone who has funds that are like unrealistic returns, like over 100% in months, because that's not the way responsible, prudent, careful portfolios are put together. And it's easy to, for someone running that massive hedge fund, when you have this story you can tell, and it's a coherent view of the world, and it all makes sense, and on all the positions, they're all coherent, and support this like well thought out story. It's easy for that person to sound really smart and raise a lot of money, and for the person, for the really careful investor who says, we restrict ourselves on our best ideas. Like, that sounds silly. Why would you do that? But like that's the prudent thing to do. That's the humble way to allocate capital. That's the risk management side of things that the cavalier investor puts aside. That's could be a really convincing story, but obviously could just lead to total ruin. And like, in the list of priorities, well before maximize returns is avoid the risk of total ruin.
Yeah, agreed. Anything else to add?
No, I like it. Thanks for sharing the story.
All right. Thank you for listening. I'm Anthony.
And I'm Sean.
I'm AJ.
Have a good day.
This podcast has been prepared by Sean Gregory, who is a portfolio manager, AJ Sanson, and Anthony De Lazari, who are associate investment advisors for IA Private Wealth Inc. Opinions expressed in this podcast are those of the portfolio manager and investment advisors only and do not necessarily reflect those of IA Private Wealth Inc. IA Private Wealth Inc. is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. IA Private Wealth is a trademark and business name under which IA Private Wealth Inc. operates.